Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today with Eric Sprott, chairman of Sprott Inc. Eric, good to see you again.
Hey, Tekoa, good to see you too.
Yeah, it's a pleasure to have you here. Now, I'm pretty excited to ask you here about starting out gold. We saw it move quite strongly from about 1150 to 1300, and we're seeing some pretty interesting currency gyrations around the world at the same time.
We are.
What goes through your mind here as you look at gold and things going on around the world?
Well, I think the comment about currency gyrations is probably the most significant thing, because I'm kind of shocked that the most volatile sector of the financial market now is the currencies, which is goes against the grain of what should happen, right? I mean, it really should be bonds or stocks or whatever, and now it seems to be currencies. And of course, this all leads into just an awesome outlook for gold. Last year, 84% of the world's population would have made money owning gold because of the various currency moves, even though gold in US dollars was down approximately 1%. As we sit here this year, I think it's now the strongest currency in the world. And you can see that the volatility of currencies is drawing in interest to gold. And we've seen that manifest itself in a number of ways. One, the Gold Trust, the GLD, has added something like 40 tons already this month, which is a stunning number when you realize it's only a 4,000 ton market. If you ever did 40 tons for 12 months, you'd have an extra 500 tons of demand in a 4,000 ton market. But also, you can see the interest in the gold stocks picking up. In Toronto, where I just came from, I think it was on Tuesday, there were 5 issues announced that totaled $500 million, and they all sold out. So we're seeing money go into the gold trust. We see the coin sales at the mints are strong. We see the money coming into the stocks. We see all the technical signs of breaking through the 200-day moving average. The UE index breaking out. Lots of stocks have had major moves already. So it's very reminiscent of how we started 2014. Now, I sure hope it doesn't end the way we started 2014. But I think the reasons to own gold with the kind of volatility we've had just could not be better than they are right now.
Eric, I want to ask you about the gold miners, the producers, in just a moment. But before going on to that, I was speaking with Rick the other day, and we talked about financial institutions, money center banks, the impact on that group of the economy, that sector of the economy, with gyrating currencies.
Right.
I've seen that leverage can be taken out 100, 200 times the amount of capital that you have on board, based on your experience in running financial organizations. Yeah. What are your thoughts on that?
Well, Tekoa, one of the reasons I got into gold way back in 2000 was that you realized that the financial system was way over levered. I mean, we had banks levered at 30 to 1, which by definition means if your assets decline by 3.33%, you've lost all your equity. And of course, that's exactly what happened in 2008. The banks effectively all went broke, except they weren't made to go broke, because the various central banks came in and governments came in to rescue them by TARPs and TALFs and QEs and so on. But we have the same situation today. Most of the banks have had very poor results. We hear stories about, whether it's Citigroup purportedly losing 150 million when the franc was revalued, and some of these hedge funds that go broke overnight. There's a lot of carnage going on out there. I'm always fascinated when I think about the quadrillion of derivatives on who knows what: oil, the ruble, the yen, the Canadian dollar, going the wrong way on the US dollar. There must be so much volatility. It's hard to imagine that somebody's not losing a lot of money here, because 1% of a quadrillion is 10 trillion. And we have things that the volatility is way beyond 1% per day in the currencies, for goodness sake. So goodness knows what's going on behind the scenes, but it can't be pretty.
Mm-hmm. Hey, Eric, do you have any memories of any friends, or possibly personally, or anecdotal items in which an individual may have shorted something that was extremely overvalued, but due to counterparty risk was unable to enjoy the profits of their speculation?
Well, shorting is a dangerous game at the best of times, right? And I've done a lot of shorting in my day. And of course, in shorting, your losses are unlimited, right? Because you never know how high something can go. And I've personally experienced times when I can be short a stock. I can remember being short Fannie Mae. I'm not sure when this was, probably in 2008, in the middle of the crisis. And Fannie had already gone from 60 down to 6. And in 2 weeks, it went to 18, just because of a squeeze. So in other words, it went up 200% in a matter of weeks. Well, it's hard as a short seller to hold on, but I can assure you that probably 4 months later, it was at $1. So it's a very volatile situation when you have things that are ultimately terminating. And we've seen lots of people suffer some massive losses. You know, we all went through that in 2000, 2001, 2002. In 2008, I mean, there were so many stocks that went down to $1, whether it's General Motors, Ford, Fannie, Freddie, Citigroup. I mean, these stocks were at $1 at the time, and now, of course, some of them have transitioned. Others have gone off into conservatorships or whatever. But markets can be incredibly volatile, and people better make sure they're on the right side of the call.
So what are your thoughts, going back here or continuing on the idea of currencies? Do you feel like that what we've seen so far in the ruble and the Swiss franc is going to roll from one country to the next over the next 10 to 15 years?
Well, it certainly looks that way. I mean, even this week we had the Canadian dollar was down 2.5% yesterday. I believe, and I haven't seen it because I've been tied up in meetings, but I believe the euro was down 1.5% today. The Danes had to go to negative interest rates to protect their currency. That was a couple of days ago. So the currency wars are in full bloom here. And, you know, most people must be sitting back just wondering what is likely to happen here, that maybe the central bankers have finally lost control. Because there's a lot of money can slosh around to try to pick on, well, what's the next weak currency going to be, or what's the next strong currency going to be? So the strong ones have to worry that they want to push it up, and the weak ones have to worry, well, the speculators might push it down. So it's hard to protect your wealth in an environment where your own currency is more volatile than any other measurable financial instrument out there, and that's what we're going through right now.
Mm-hmm. I've had the opportunity to speak with you in the past about aggressive strategies in precious metals and mining stocks, but I'd like to ask you here now about core strategies, physical bullion, personal ownership. I know that there are the physical bullion trusts, but what are some core strategies a person can take to insulate their lifestyles?
Well, as you know, I'm a huge proponent of owning gold and anything related to precious metals. I know there's been lots of studies done about how much gold one should have, and you had various studies from 5 to 7 to 10% of your portfolio. I'm of the view, and I'm positioned, that I'm way more involved in precious metals than those kinds of numbers, because I believe we are in a financial Ponzi that's been perpetuated by the printing of money, zero interest rates, negative interest rates now, and it's almost, it's inexplicable that the markets can sustain these things and that the economies can function with no return to savers, which negative interest rates imply. And now with all the currency volatility on top of it, imagine if you're an owner of a bond and you have a German bond and you're already losing 0.5%, and then the euro goes down 1.5% in a day. Not only do you lose on the interest, now you lose on the currency. I mean, how do you deal with this very odd situation that we're in? So all of this leads me to recommend, and not that I'm not a financial advisor per se, but I know someone like myself, for quite a while now, I've had 80% of my money in precious metals, and notwithstanding the carnage that we've gone through here in the last 3 years, when all of the physical data, the movements of physical gold tell me that there's more demand than supply, I'm quite prepared to stand in there, notwithstanding the paper markets suggesting that the end is near. I'm quite prepared to stand in there and fully expect that we end up seeing new highs in all the metals here.
I want to ask you now about the marginal producer strategy, which we've talked about a year ago, in terms of the magnitude of return that one can find in a strong move up in the price of gold.
Yeah.
Could you talk a little bit about the mathematics of that? How many do you need to own?
Sure.
What can go wrong?
Yeah. Well, I mean, it depends on your appetite, because, you know, let's just imagine that somebody's cost is $1,000 and the price was $1,200, so fine, you're working with $200 a margin. I mean, at $2,000, now you have 5 times that margin, which by implication might suggest a stock could go up by 5 times. In fact, it might even go up more, because the reason it's gone to 2,000 is everything else is kind of falling away, and it's the one area to invest in, and the valuations, it could even go higher than that. And you know, if there's imagine a marginal producer who's doing it 1,100, and he's only making 100, then now he's making 900. That stock can go up 9 times based on an earnings multiple. So there's lots of opportunity there. It takes a little bit of intestinal fortitude to want to be there, because you can suffer the risk of the price going back down. But as you know, I've invested in lots of these types of investments. I did it before in 2000 when no one cared, and I mean, in that time, I think the UE Gold Index went up 1,700% in a matter of about 8 to 10 years. So it was just a wonderful time to own gold. And I think that we might be in that same type of environment today, where they got so sold out, everybody suggested it was over, but obviously it wasn't over. The reasons for gold going up, and silver for that matter, are totally apparent to anyone who wants to think about it. And so the opportunities are going to present themselves in the miners as well as owners of the precious metals themselves.
I've heard that George Soros often finds or looks for commonly held precepts that are wrong in terms of identifying a potential investment thesis. Using that general idea outside of gold and silver, which you know our viewers know you're a very big proponent of, are there any other commonly held precepts around the world today that are absolutely wrong, in your opinion?
I mean, the whole precept that printing money is good, and I'm sure is totally fallacious. The concept that somehow zero interest rates and negative interest rates are good is, I'm sure, totally fallacious, because the whole savings segment of the world can't earn a return. It's like, you know, saying you had $1 million in the pension fund, and what did you earn on it? Well, I didn't earn anything. I lost, you know, 0.5% a year. Well, how do we get progress out of that when you have such low and sometimes negative interest rates? So that's a fallacy. I think another fallacy is, you know, when we went into 2012 is going to be a great year. It wasn't. 2013 is going to be a great year. 2014 is going to be a great year. This is always at the beginning of the year, right? Then you get to the end of the year and it's never great. 2015, you know, people are suggesting maybe the U.S. economy is going to be strong. I don't think that there is any serious growth that's going on in the economy. We have people making decisions to let more and more people buy houses who shouldn't buy them, buy cars that shouldn't own them and can't afford them. And essentially, you know, we're not likely to have a recovery. We have a US dollar that's strong. That cannot be good for the economy. I mean, the same strength in the franc that's so bad for the Swiss economy also holds true for the dollar being strong. It's not good for the US economy. And as a Canadian, I can tell you, we can already see a shift where, you know, some of the auto production starts moving up into Canada, because the dollar's trading at, our dollar's at $1.20, or put the reverse 82 cents to the US dollar. So car companies shift the production up here. And that's why strong currencies don't lead to strengthening economies. And that's why you have this currency war. Everyone wants to have the worst currency. There's a fight to see who's the worst, right? So that's another thing that I don't think people understand. There's no real growth. Money printing's not going to work, and zero interest rate policy is not going to work.
Winding down, any other thoughts that you have in mind that you think that we may have missed?
Well, I think the theme is the same. I mean, we haven't really talked about the physicalness of gold, but you know, I wake up this morning, I read that the Chinese delivered 61 tons in the Shanghai exchange this week. I love to work with numbers. 60 tons a week is 240 tons a month. Well, we only mine 180 tons a month. So here we have more deliveries on the Shanghai Gold Exchange than we mine in a month. And that's just one country. I mean, I've been so pleased by the demand out of India, China. It looks like India might cut the import tariff. You can sort of sense that's going to happen. I think it's interesting that the ECB is going to start printing money in March, which was just announced today. And I suspect that the Japanese are going to stop printing at the end of February, and we're just going to pass the baton along. A day after the US stopped QE3, Japan started their QE. And I don't think it's very ironic that one would happen right after the other, because I think they need to have somebody buying these bonds, otherwise these rates will go straight through the roof. So there's all sorts of interesting things going on that I think all lead one to saying the true safest asset is to be in precious metals. So that would be my summary.
As one last final question
Sure.
for you, Eric, how do you expect the world might look in maybe 20, 30 years, currency-wise? Broad question.
Well, you know, if I was to bet that in less than 20 or 30 years, we will have to have a gold-backed currency. It's just going to happen. There's no way that governments can keep spending the money they spend and printing the money they print. I mean, it's so unimaginable. And yet somehow the investment public has bought into it. But you know, you'll never read about printing money in an economics textbook, okay? Because it never happened before. You'll never hear about negative interest rates in an economic textbook because it never happened before. And I think, you know, to your audience, those words, "it's never happened before," should awaken them to, you know, things are rather unstable here. We are fighting the natural decline of the economy that should be taking place, and the powers that be don't want to let it happen. And the more they delay it, the worse it will get. So I would imagine probably even in less than 10 years, we'll see materials, physical assets backing currencies. And of course, the most likely one is gold.
Eric Sprott, Chairman of Sprott Inc., thanks for sharing your comments with us.
Takoa, my pleasure. All the best to you.